Hello and thanks for joining. As 2025 nears an end, one of the things we like to do is release our 2026 outlook, where we see things headed from the economy, the markets, sentiment, earnings, all of those things that encompass a sentiment backdrop that can influence the stock market, the bond market, and all other assets, and just consumers in general. But before we do that, let's dive back into 2024 at this time last year, where we released our 2025 outlook, and see how things transpired from that standpoint. One of the things we always like to assess is what are the factors that are likely to impact the stock market and the bond market. And of course, the simplicity of things like earnings expectations and labor market and just economic growth in general tend to be very, very dominant topics. One of the things we focused on in our view of 2025 was this notion that a soft landing, or rather this lack of a recessionary backdrop, was likely to materialize as such in 2025. The momentum of earnings was strong. Consumer sentiment was strong. And although the labor market was cooling to a very small marginal degree, the health of the labor market remained robust. As we looked at that relative to what may happen to commodities, things like oil prices, for example, the sustainability of those to remain at fairly neutral levels appeared to be very much intact. We knew the administration that was coming into the White House. We knew the backdrop of what was likely to happen with the domestic energy independence story, and we knew that sentiment in general across earnings appeared to be very strong. As a result, we favored equity market participation. We favored diversified equity market participation, not an exuberant chasing of performance momentum, but we certainly abided by the fact that fixed income was likely to carry more risks than stocks in 2025. This was, of course, against conventional wisdom heading into the year, but it was one of the things that defined our risk management approach. Because as we have stated numerous times in the past, the markets rarely react the way the masses expect them to. In the case of 2025, interest rates were expected to drop meaningfully lower. Although they did drop, it wasn't such a substantial downside that would have substantiated an overweight to fixed income assets. Additionally, in 2025, one of the things we were adamant about was the uncertainty from trade policy, and not necessarily the lack of trading capacity of the United States or lack of trading abilities, but rather the rhetoric and the sentiment tied behind it. Throughout this year, 2025, we have seen numerous noise volatility cycles derived from trade policy and tariff rhetoric. That's not likely to subside, and it certainly did not subside in 2025. Yet that was no reason to forego equity market participation. So 2025 in general, again, to briefly recap, our view was of a soft landing of a no recessionary backdrop, which we released back in 2024. It was of an equity market participation profile, which proved very, very adamant. And it was of a reduction in the allocation to broad fixed income assets or bonds, with this idea that rates were going to substantially drop lower. Those things materialized very well for our clients. The objective approach to decision-making remained intact, and it was that portfolio risk management that proved to be notably more beneficial than seeking a momentum in performance chasing throughout the year. So as 2025 does near an end here over the next month or so, let's look ahead into 2026 and how we anticipate economic activity and broad markets to react. From a broad economic standpoint, the current business cycle has certainly been one of an elongated phase, meaning we have gone a very, very long time without a neutrality in growth, or some would call a recession. And although we are not foreseeing a recession in 2026, it remains paramount to note that a neutralization of growth, a more neutral approach to retail sales, a more neutral kind of normalization of demand, even post-COVID in this era 5-6 years out, all of that is likely to come into fruition. Now, of course, none of that means a notable decline in sentiment or economic activity. I want to stress that. But what it does mean is that that linear growth cycle post-2020, even throughout 2025, cannot be sustained as such in perpetuity. It's the normal business cycle that actually ebbs and flows, every 7 to 10 to 11 years across the economic history of the United States, and 2026 is not likely to be any different on that front. The catalyst that we foresee for such a neutralization and normalization of that growth cycle is the fact that the labor market may continue to cool a bit further. Of course, that cooling, which has already started here in the fourth quarter of 2025, leading into next year, is likely to be minimal in nature and is likely to be one that is notably baked into capital markets like the stock market or the bond market. We do not foresee any major shifts in there that would actually cause market participants to be weary of their allocations that would cause this notable volatility cycle. The reality is, as we look at 2026 from a valuation perspective, the stock market in general, especially here domestically in the United States, tends to be of a potentially overvalued nature. Now, overvalued should not cause warning or rather risk in that sense. Valuations of themselves have never, ever proven to be a good market timing indicator. In fact, valuations tend to be irrational for notably longer periods than investors would like to see them, but that doesn't mean that not participating in the stock market makes sense. One of the ways that we foresee 2026 panning out is that we could easily see a downside in broad equity markets like the S&P 500, yet we could see the average stock gain value. That may sound like it's against conventional wisdom, but the fact of how artificial intelligence top-heavy the S&P 500 is may result in the average stock in a more broadly diversified sector base to perform better across capital markets. From a risk management standpoint, we are positioned to take advantage of this broadening cycle within U.S. equities and even international equities for that front. When we look at the economic policy backdrop in general for 2026, one of the things to note is that we're probably going to see more tariff rhetoric across the spectrum. This may cause short bursts of volatility, which will completely change the narrative of what it means to take advantage of short-term opportunities. One of the benefits of how we're going to be allocated in 2026 from a risk management standpoint, from an equal weighted standpoint, and not a cap weighted, mega cap, performance chasing structure, will give us ample ability to tap into small pockets of opportunities throughout 2026. And lastly, one of the things that we could see some tremendous benefits in throughout the year is in the housing market. The housing market leading up to here at the end of 2025 has been one of some ebbs and flows. Interest rates are dropping, demand is remaining steady, and we're starting to see houses stay on the market for a little longer than usual. As rates do continue to drop, which is likely to be the case here into 2026, with the federal funds rate likely dropping to that 3.5% area, or that between 3 to 3.5%, it's possible that housing market is likely to gain some serious momentum, which may bolster part of the economic backdrop story. Alongside that, we do see a neutralization, or rather a sustained oil price backdrop. I think this will be a tremendous positive sentiment for U.S. consumers. And we are likely to see the bond market in general behave as expected. With that in mind, similar to 2025, we do foresee more risks in bonds than stocks in 2026. And I want to stress that, more risks in bonds than stocks in 2026. The reason for that is that the current trajectory, the priced-in sentiment for the bond market indicates one of even lower interest rates. If that doesn't materialize as currently baked in, or if there is this off chance that the labor market does not cool in any capacity, or if any sort of Federal Reserve president changes their rhetoric or their tone, it will immediately change the sentiment backdrop in bonds. As a result, we're playing some serious risk management backdrop in the bond market. We are not going full long duration. We are keeping investors in a very, very mild belly of the yield curve structure. And again, we stand to take advantage of equity market opportunities as they arise throughout 2026. As always, focus on the things you can control as you look at 2026. Things like saving more than spending. Things like equity market participation. Other components that impact your ability to control how you foresee your financial future. We're here to help you. We're here to be your risk managers on the back end, to be your financial planners to guide you throughout life's most important financial events. If you have any questions whatsoever, please reach out to your financial advisor. And here's to a great 2026.